Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, Elliott wave theory, surfing market cycles. Imagine just staring at a screen of chaotic, zigzagging lines, trillions of dollars moving seemingly at random, and then realizing that hidden inside all of that chaos is actually a perfectly repeating mathematical pattern.
Right, a pattern driven entirely by human greed and fear.
Exactly. And that is, that's the whole premise we're diving into today with the source material.
It is, yeah, and that's the ultimate promise of the theory, because if you look at traditional technical analysis, a lot of it operates like engineering, right?
Yeah.
You're looking for a support line or a resistance level, maybe a moving average cross.
These are standard chart stuff.
Right, and it assumes this level of mechanical rationality. But markets are not machines. They are just this massive aggregate of human emotion.
Yeah.
You are essentially looking at the combined hopes, panics, and FOMO of millions of participants.
Which is wild when you think about it.
It is. And trying to diagnose that collective human psychology well, it requires an entirely different set of tools.
Which is why the Elliott wave principle is so fascinating to me. We are basically stepping away from, balance sheets and earnings multiples, and we are looking exclusively at these extremes in investor psychology.
Right, psychology and price levels.
Yeah. The goal is to forecast trends based on how people feel and how those feelings inevitably swing back and forth like a pendulum. And the architect of this whole framework, Ralph Nelson Elliott, he wasn't even a Wall Street insider.
No, not at all. He was an American accountant.
Right, accountant.
Yeah, he actually developed this theory back in the 1930s. He was studying just decades of historical stock market data, looking at the aftermath of massive generation-defining volatility.
So he was digging through the ultimate market chaos.
Exactly. And the general consensus at the time was that the market was just a random walk, just a chaotic series of unpredictable events. But he brought this accountant's rigorous eye for order to that absolute chaos.
Okay, let's unpack this. How did an accountant from the 1930s come up with a system that modern investors use to map out trader optimism and pessimism? Going from auditing ledger books to diagnosing global market psychology, that feels like a massive leap.
What's fascinating here is that Elliott didn't actually start with the psychology. He started with the math.
Oh, interesting.
Yeah, he noticed that market prices didn't just fluctuate wildly without reason. They moved in these repeating sequences of intensity and duration. And it was really only after identifying the structural patterns on the charts that he realized why they were happening.
So the patterns came first.
Exactly. He realized that human collective psychology moves between optimism and pessimism in predictable waves. Because human nature is fixed like, we oscillate between greed and fear exactly the same way we did a century ago.
Wow, yeah. We haven't changed at all.
We really haven't.
Okay.
And those emotional swings create actual repeating recognizable structures in price movements.
So the market is basically just a massive mood ring, and he figured out how to read the colors.
That's a great way to put it, yeah.
So now we need to understand how this theory actually visualizes these emotional swings. Because our sources highlight two primary phases in any market cycle. You've got the motive phase, which is often called the impulsive phase, where prices surge in the direction of the main overarching trend. And then you have the corrective phase, where the market pulls back against that main trend.
Think of it like a riptide, honestly. The motive phase is the massive dominant volume of water pulling you out to sea.
Right.
And the corrective phase is your attempt to swim back to shore. Like, you might make a little bit of localized progress, but the overarching current is infinitely stronger.
You're still going out to sea.
Exactly. And Elliott proposed that this push and pull, it doesn't just happen randomly. It unfolds in a very specific structural sequence based on the numbers 5 and 3.
Here's where it gets really interesting. Because if we look at the anatomy of this 5-3 structure, it is essentially a relay race of human emotion, right? So let's use a bull market as a concrete example. The motive phase, that dominant upward trend, it always unfolds in a 5-wave pattern. So waves 1, 3, and 5 are the impulses driving the trend forward.
Upward.
And waves 2 and 4 are the corrective dips along the way. But let's look at the psychology behind those numbers. Because wave 1 isn't just a line moving up. Wave 1 is the contrarians. It's the smart money stepping into a depressed market, buying when literally everyone else is terrified.
Right. That initial burst of courage really sets the stage. But courage is incredibly fragile in a beaten down market. So naturally, you get wave two.
The first dip.
Yeah, and this is usually a severe corrective dip. Those early buyers, they get nervous and they take their profits. And the bears who miss the bottom think, well, the downtrend is resuming, so they short the market.
So wave two looks really scary.
It looks incredibly aggressive. It often retraces almost all of wave one, but, and this is crucial, it stops just short of breaking that initial low. It's basically this brutal reality check that tests the conviction of the new trend.
And once that conviction holds, that's when the magic happens. We get wave three. And in the Elliott wave framework, wave three is often the longest and most powerful wave.
Oh, absolutely. This is the stampede.
Yeah. The fundamentals finally start aligning with the technicals. The news turns positive. The mainstream crowd realizes they're missing out, and the FOMO just kicks in hard. The volume is massive.
This is the wave where the trend becomes completely undeniable to the general public.
Right. But because it is so massive, it eventually exhausts itself, like the market has sprinted too fast, too far. And that brings us to wave four.
The nervous digestion period.
Exactly. People who bought the bottom are sitting on massive gains, and they decide to lock them in.
But unlike the terror of wave two, the underlying sentiment in wave four is still generally bullish. Like buyers are stepping in on the dips, which creates this complex, often sideways holding pattern. The market is just catching its breath.
Which sets up the grand finale, wave five. This is pure irrational exuberance.
My favorite kind.
Right. The smart money's already exiting, but the late-to-the-party crowd is just throwing their money in blindly. This is when your neighbor with no financial background starts giving you stock tips.
That is always the sign.
Always. The momentum is actually weaker than in wave three, but the price is pushed to new highs purely on greed, just completely detaching from underlying fundamentals. So that is the five-wave modus structure.
And importantly, that exhaustion at the top of wave five, it doesn't just evaporate. It triggers a structural unwinding. So once the five-wave sequence finishes, the theory dictates that a larger corrective phase begins, and this moves against the main trend.
And this is the three-part structure.
Yes. This correction takes the shape of a three-wave structure, commonly labeled A, B, and C. So wave A is the initial shock. Wave B is this deceptive dead cat bounce where people think, oh, the bull market is returning.
But it's a trap.
Total trap. And then wave C is the devastating final drop that fleshes out the weak hands and completely resets the psychology for a brand new cycle.
So the entire heartbeat of the market is basically 5 steps forward, driven by an evolution from courage to greed, followed by a 3-step structural unwinding, driven by a return to fear.
That is the core architecture, yeah. But to add a layer of depth here, the CFA Institute notes that these patterns are fundamentally fractal in nature.
Now, I love the concept of fractals. It's like looking at a fern in the forest or a snowflake. You look at the whole shape and it's beautiful. But if you take a magnifying glass and you zoom in on one tiny branch of that fern, it is an exact miniature replica of the entire plant. You zoom in again, same thing.
Right. And that biological architecture applies directly to financial charts. The wave of patterns repeat across entirely different time frames.
So across decades and minutes.
Exactly. A massive decade-long secular bull market might be one giant 5-wave structure. But if you zoom in on wave 1 of that decade-long chart, it is constructed out of smaller 5-wave sequences on the monthly chart.
Oh, wow.
And those monthly waves subdivide into weekly waves, daily waves, all the way down to the minute-by-minute fluctuations of day traders. The 5-3 structure remains constant regardless of the magnification.
That is absolutely mind-bending. Just the idea that a momentary spike on a 5-minute chart is mathematically related to a 10-year macroeconomic trend. But, I mean, from a practical standpoint, that sounds like an absolute nightmare to track.
It's definitely a challenge.
Right, because if you are just drawing lines on a chart, how do you keep it all straight?
Well, you need incredibly strict guardrails. Practitioners of the theory operate under 3 unbreakable rules for a valid wave count.
Okay, what are they?
First, wave 2 can never retrace more than 100% of wave 1. If it breaks the starting point, your count is just wrong. Second, wave 3 can never be the shortest of the 3 motive waves. It doesn't have to be the longest, but it can never be the shortest.
Makes sense, since it's the stampede.
Exactly. And third, wave 4 can never overlap with the price territory of wave 1. If any of those structural rules are violated, the analyst basically has to throw out their chart and start over.
Okay, but beyond those hard rules, the sources also mention these guidelines to help analysts navigate the structure. And The most fascinating one to me is this guideline of alternation.
Yes, alternation is huge.
It essentially dictates that the market rarely repeats the exact same corrective behavior back-to-back within a single sequence, right?
Right, and alternation is where the psychology of the market becomes incredibly visible. It observes that in a five-wave pattern, the two corrective waves, so that's wave 2 and wave 4, will almost always take alternate forms.
Let's dig into the why of that, because it's not just a geometric coincidence. It's about market memory. If wave 2 is a very sharp, steep, terrifying correction that drops suddenly and wipes out leveraged traders, the market remembers that trauma.
It absolutely does. The market is cleansed, sure, but the surviving participants are jumpy. They're on edge. So months later, when the wave 4 correction begins, the guideline of alternation suggests it won't be another sheer cliff. Because investors are already anticipating a drop, they act cautiously. They hedge their bets.
So they don't panic sell all at once.
Exactly. And the result is a mild, drawn-out, sideways correction. It's this agonizing grind where people wait for a crash that never actually comes before finally grinding higher into wave 5. The psychological mechanism of once bitten, twice shy literally dictates the shape of the chart.
Okay, I have to jump in here and play the curious skeptic. Because if this entire system is a fractal, and there are waves inside of waves inside of waves, and we are relying on guidelines like alternation, couldn't a corrective wave just be a tiny blip inside a giant motive wave?
It could, yeah.
Right. So if I'm staring at a chart trying to find a tiny 5-wave fractal inside a 10-year trend, how on earth does a trader know where they actually are in the sequence? I mean, it feels like you could be standing on the beach, looking at a ripple, and tricking yourself into thinking it's the tide going out.
If we connect this to the bigger picture, you are hitting on the exact reason why this theory is so polarizing in the financial community. The complexity of nested fractal patterns is just staggering.
I can imagine.
It requires a remarkably high degree of technical expertise to apply this in practice. You aren't just looking for 5 waves in a vacuum. You are trying to contextualize a microscopic 5-minute wave within the larger historical pattern of a weekly chart.
It sounds exhausting.
It takes immense discipline. You have to keep track of the wave counts and adhere strictly to those 3 rules without letting your own bias creep in.
Which leads perfectly to the biggest criticism of the entire framework. If it requires absolute perfection to read the chart, and human beings are inherently imperfect and, emotional, is this actually a reliable science?
Well, that is the crux of the debate among institutional traders. The most common pitfall of the Elliott wave principle is its extreme subjectivity. It is wildly open to interpretation.
Really? Even with the strict rules?
Oh, absolutely. You could put 3 highly experienced Elliott wave analysts in a room, give them the exact same price chart, and they will likely identify completely different wave degrees. They might have totally conflicting counts.
Oh, wow. So they wouldn't even agree on what's happening right now.
Exactly. Analyst A says we are in a bullish wave 3, while Analyst B says, no, we are in a bearish wave C. And because their counts differ, they will produce entirely conflicting predictions about what the market will do next.
Because at the end of the day, you are trying to quantify something that is inherently unquantifiable. You can't just put human emotion into a spreadsheet and get a perfect, infallible mathematical output.
Right, and that subjectivity opens the door to a very specific psychological critique. A lot of quantitative analysts argue that the Elliott wave principle is really nothing more than a massive exercise in pareidolia.
Pareidolia, that's the psychological phenomenon where we see faces in the clouds, right? Or the man in the moon. Our brains are basically desperate for pattern recognition.
Yes. We are hardwired to find order in chaos as a survival mechanism. So critics suggest that analysts stare at random price data, trillions of dollars of chaotic, algorithmic, and human fluctuations, and their brains essentially force those zigzags to fit into an Elliott wave structure.
They're finding faces in the clouds.
Exactly. They are finding a 5-3 pattern in random data where no actual predictive pattern exists.
So what does this all mean? If analysts can't even agree on the wave count, and there's a very real danger that we are just seeing what we want to see, is this just astrology for investors? Or is there real tangible value in applying this framework despite the subjectivity and the risk of pareidolia?
This raises an important question about how we view technical analysis as a whole. The Elliott wave principle is not a crystal ball. It is never going to give you a 100% guaranteed prediction of the future, but what it does provide is a rigorous framework for understanding context. It forces an investor to step back from the daily noise, the panic of the news cycle, and ask, are we structurally in an impulsive phase fueled by optimism, or are we in a corrective phase driven by pessimism?
It demands that you take the temperature of the room before making a decision.
Exactly.
Even if the exact wave count is debatable, just the discipline of assessing the market's psychological state is incredibly valuable. It shifts your mindset from reacting blindly to price drops to anticipating potential scenarios based on historical human behavior.
It provides vocabulary for the unknown. When you understand the mechanics of wave 5 exhaustion, or that sideways grind of a wave 4 alternation, you are much less likely to panic sell at the exact wrong moment.
Okay, let's pull all of this together into our key takeaways for you listening right now. We started by exploring the origins with Ralph Nelson Elliott, an accountant who discovered that the chaotic fluctuations of market prices actually unfold in specific repeating patterns driven entirely by the pendulum swing of investor optimism and pessimism.
Right, and we broke down the anatomy of those emotional swings, the motive or impulsive phase, which typically unfolds in 5 waves, moving from the early contrarians through the mainstream FOMO all the way to irrational exuberance.
And then we looked at the structural unwinding of the corrective phase, which unfolds in that 3-wave ABC pattern.
We also explored the incredible fractal nature of these markets, how a massive macroeconomic cycle is built out of miniature, identical structures all the way down to a minute-by-minute chart.
Yeah, that still blows my mind. We discussed the strict, unbreakable rules for counting waves and that fascinating guideline of alternation, where the Marcus memory dictates that corrective waves 2 and 4 will usually take on entirely different shapes.
But we also heavily weighed the very real pitfalls. The subjectivity of the theory, the conflicting predictions among seasoned analysts, and the psychological danger of pareidolia forcing random market noise into neat, comfortable patterns. It demands a highly disciplined level of technical expertise to avoid letting your own bias dictate your wave count.
But despite those pitfalls, the core value remains incredibly potent. The CFA Institute notes that the theory can be actively used by investors to identify asymmetric opportunities for buying and selling securities. It gives you a structured, historical way to anticipate potential market movements, manage your risk, and ultimately aim to maximize returns. It really is a powerful lens for reading the collective mood of the global market.
It is. And I want to leave you with a final thought to mull over today. We've talked extensively about how the Elliott wave principle relies entirely on the idea of unconscious collective trader psychology, right? The crowd acting on primal instinct, totally unaware of the fractal patterns they are creating.
Right.
But today, we live in a world where more and more algorithms, institutional quants, and retail traders are actively using this very principle to map the market.
Oh, interesting.
So, does the sheer act of millions of people and computers actively looking for the waves fundamentally change the underlying psychology that creates them? If a critical mass of the market expects a wave 5 exhaustion, does the anticipation alter the wave itself? Do the patterns survive when the crowd becomes self-aware?
Taking that original idea of an X-ray and realizing that the sheer act of observing the bones might actually be changing their structure, a fascinating observer effect for financial markets. That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.